I'm your host, Niraj Shah. The last few days, the market moves have befuddled almost the best of people. But for a long-term investor, he would be enthused or she would be enthused by the way the moves have been taken by the government. And I think the questions directed to our guest today would be whether he believes that the course ahead for the equity markets, Indian equities in particular, would be a factor of what the government does and deliver, or would we be still largely at the mercy of what the global markets do? I think one of the answers would be that it will be a combination of the two. But let me ask Ashwini Agarwal of Ashmore about how he thinks about the markets going ahead. What would be the dominant part of the two, and how then does he fish in this pond of equities available currently? Ashwini, so good having you. It's been a while. Thank you so much for speaking to us. Hope all is safe.
Morning. All is good, Niraj. Thank you for having me.
The pleasure is ours. So Ashwini, straight off the bat, if there was one thing that described the markets over the last maybe 15 days, it's volatility, and a lot of global volatility impacting us as well. What's your sense of what happens here on, now that the budget is out of the way, now that a very robust Q3 earnings season was about a month behind, and we also have had the US stimulus announcements being made?
So, Niraj, all very interesting questions. I mean, the volatility, if you see, has been sort of led by the very, very sharp spike in bond yields. But let's put some historical perspective to it, right? Prior to COVID, the 10-year government bonds in the United States were closer to about 2%. They hit a high of 1.6% and have been trading, say, plus minus in that territory for a week or so. And if you see the increase from, let's say, last March of about, say, 0.6% to 1.6%, some of it is led by inflationary expectations, and some of it has been led by growth expectations. And typically, this kind of move in the past has indicated very, very robust economic growth ahead. So even if you look at many of the estimates that are coming out of Wall Street watchers, they're talking about a very strong economic recovery in the US post the pandemic, and it should be visible later this year. Now, if I put all these factors together, and on top of it, I layer the fact that central bankers across the world are very, very clear that they are not going to let the step off the gas insofar as liquidity is concerned till the pandemic is clearly in the rearview mirror, I think the significant volatility and nervousness relating to rates is possibly behind us. So from a global perspective, honestly, the only thing that worries me is the crude oil price. And that is actually more relevant for India than actually the bond yields are. In the Indian context, I think, if bond yields have gone from, let's say, 5.9 to 6.25, even if they were to, for argument's sake, go to 6.5 or 6.75, I don't think that's a big game changer. Some amount of inflation is good for corporate earnings. Some amount of increase in interest rates is not something that will derail capex plans or ability of people to invest in the country. So I don't think that worries me a lot. What I'm actually looking at is, will the government deliver on the promises that it has made? It's not just a budget, Niraj. If you think about, what the Prime Minister has said on the floor of the Parliament, what the Finance Minister has said in various forums, it would indicate to me that there is a huge tectonic shift in the way the government is looking at the role of PSUs in the Indian economy, what it means, for the investment plans of the government, creating the social, human, and physical infrastructure required for growth, and allowing the private sector to prosper. I mean, these are very, very big changes. So I'll be very keen to see delivery on these fronts. And if delivery on these fronts happen, then I think the global factors are, in my view, not a risk for the Indian market outlook, at least.
Interesting. I was just wanting to ask you, Ashwini, wouldn't some of this inflationary expectations coming back and some bit of inflation coming back be actually good? I mean, some bit of pricing power, some bit of this much needed growth-led inflation. Shouldn't it rather be welcomed by the market as opposed to being nervous about it?
You're absolutely right. And that's what I said. I mean, to me, moderate inflation is actually great because it helps people invest. I mean, at the end of the day, when you borrow money and you have to pay a rate of interest on it, what helps you is if nominal growth picks up, your nominal top line expands, and that allows you to meet that cost of borrowed capital. So some amount of inflation is actually very good. It's only when inflation gets to levels where it gets entrenched in inflationary expectations that you have a problem. So, for example, I mean, you've had WPI in the range of 2 or 3%, CPI in the region of 5%, give or take. I think this is fine. I think the problem would be if CPI were to get to 9 or 10%. That is what happened in 2009 and 2010. And that is when inflationary expectations go for a toss, and that is what creates a problem. I think we are very far from that. And the risk, to my mind, is essentially crude oil. I mean, all of us, if you asked us, say, 6 months ago, would have said, yeah, it can go to 50, it can go to 60. None of us would have thought 64, 65, which is where it is today. I mean, I don't think it's a risk even if it goes to 70, but if it goes to 100, I mean, I can't forecast this. But if it goes to 100 for reasons that I can't forecast, then there will be a problem. But modest inflation, you are dead right, is very, very good for everyone. It's good for corporate earnings. It's good for government tax collections. It's good for pricing power of most businesses. I mean, it is at the end of the day good for the consumer because it allows him to negotiate, some wage increases which don't come through otherwise.
Yeah, very importantly. And I think I'm so glad you mentioned that it's just so difficult to forecast. I see Chris would speak about 100 to the barrel, and many others come and say that, once these supply side issues ease out, you will not see it go up. Maybe 2 days from now, March 4th, the OPEC meet might give us some cues. But be that as it may, let's work with a hypothesis, Ashwini, that, crude doesn't throw up very nasty surprises. And we all know that the April to June quarter will be the one led with strong earnings growth, and which is because of the base effect. But net, compared to expectations, do you reckon that the pace of earnings growth, because of this commodity inflation, comes under a bit of a risk? And could that disappoint the street? Because hitherto, the street has been working with how wonderfully well India did in Q2 and Q3. And therefore, imagine what it could do in a year when the base numbers will be great. But could the commodity price inflation hit the earnings estimates a bit?
So there are some headwinds, to margins. Rising material and energy costs is one in the short run. Several companies in their commentary for the December quarter have said that they've taken price increases, but those price increases will not completely offset the inflation in costs that they are seeing. So the question arises that how strong is the revenue growth? Because if the revenue growth is strong, then the operating leverage can hopefully offset some of the raw material price increase. But is it possible that you see some gross margin pressure, in the March quarter, in the June quarter? Yes, it's possible. That doesn't faze me so much. What I would be keenly watching is how does demand unfold. To me, that is the real deal. If demand holds up, if growth comes back in several sectors which are still growing well below the same rate as last year, whether it's transportation, whether it's leisure, whether it's travel and entertainment. I mean, if these activities start to come back, if job creation happens, if revenue growth takes hold, then I think the short-term margin pressure is something that investors will be willing to look through. Because a combination of inflation and a combination of robust growth allows you to pass the rising costs through. And that, to me, is the assessment we have to make. I mean, if demand is soft, and even if input costs are soft and your revenue doesn't grow, then you're not in a great place at all. It doesn't matter. So I would be watching for domestic demand. I would be watching for what the government is able to do on the front of privatization. I mean, is it actually able to push through the 2 or 3 things that need to happen over the next quarter or two? Use that money, to fund its human infrastructure and physical infrastructure. Do some of these PLI-led investments start taking root? I mean, these are the things to watch, in my opinion.
Yeah. Okay. So two questions based out of this answer. The other one will be on divestment and government revenues because of the GST collections as well. Now being over 1 lakh crore for fifth month in a row. But before that, what's the base case on demand? I know it's difficult to forecast and you are watching out for that, but what's your base case?
Our sense is that demand should be reasonably strong. That's what all the data is showing. I mean, if you just look at the auto sales data for the month of February that has just come out, if you look at the manufacturing PMI for February that was released yesterday morning, I mean, we are seeing a significant amount of production activity for sure. Auto companies are saying that they could have done more had it not been for some shortage of raw materials, especially on the semiconductor side. So I don't think demand is an issue at this point in time. Consumer inflation is also coming off a little bit, courtesy softer food prices, and that effect should remain in place at least for the next 3 or 4 months. And incrementally, COVID, which, if you ask me, had started to get me a little worried 1.5 weeks ago, 2 weeks ago. I think the numbers are telling us that it's not a full-fledged second wave. It's more arising out of the easing transportation, easing movement that has come through. So some increase in numbers was probably likely, and that's what we are seeing. And with the vaccination drive now in full swing, one hopes that, we won't see a negative shock on the COVID numbers or any, lockdowns or anything of that nature. I mean, if you make these assumptions, and I know I'm asking you to make a lot of assumptions, but that's the world we live in, right? If you make these assumptions, then I think demand will be fine. I don't see a problem. We've often wondered that, a lot of small businesses, individual self-employed people have seen a significant hit to their earnings and their savings over the last 9 months. And whether that will show up, with a lag in softer demand, it's possible. I mean, that argument has a lot of merit, but data doesn't say so right now.
Yeah, and that's the counter that a lot of inflation doves give as well. That while you're talking about inflation moving up, with the kind of hit that the small guy has seen, maybe inflation will not come back. But okay, so that's part one of the question that I had. Part two is this whole government piece that you invoked, right? The divestment and the money that comes in. But the point that a few people have made also is, Ashwini, that if indeed GST collections in the current economic activity scenario are looking the way they are, if economy does pick up, as we believe it would, and economic growth picks up, and therefore if the GST collections actually move higher, then it actually gives the government elbow room to do a lot more, and maybe the glide path that they spoke about would come in a bit quicker than what they are forecasting right now, and that all of this should net be positive. What's your sense around this argument?
It's possible, Niraj. One of the things I've learned in forecasting corporate earnings is that you are never able to accurately predict operating leverage. So, what you speak about is actually the government's operating leverage on faster growth, right? So when you draw tax, forecast or tax collection forecast, you make certain base case assumptions. You make base case assumptions on inflation. You make base case assumptions on growth. But you could get both those numbers wrong, and the ripple effect on tax collections can be much higher than anticipated. We still don't fully understand the shift in compliance standards. GST was introduced in middle of 2018. Anecdotally, we know that a lot of businesses that were probably not entirely tax compliant have become fully tax compliant. The COVID pandemic has anyway shifted the weight in favor of more organized players than less organized players, which is again good for tax efficiency and appropriate collection. So can the tax revenue surprise? Yeah, they could. I I wouldn't say that's impossible, but I'm not hanging my hopes on that. I mean, if that happens, that's an additional positive. For now, I think I'm really focusing on the fact that the pandemic indeed has enunciated focus on efficiency in the economy, on scale operations in the economy, on the role of the private sector in the economy, which to me are very, very important strategic choices the government appears to have made. Now, as things go along, will they backtrack? Will political reality force them to, roll back some of these initiatives? One doesn't know. One has to wait and watch. If you look at the recent agricultural reforms that were introduced by the government, as somebody who is not involved in agriculture and watches it from the outside, I think they are very much required. But political reality is something else. So we'll have to see how these things play out.
Yeah, well said. Yeah, and actually, you hit the nail on the head. So, in which case, Ashwini, you made certain assumptions about various factors, and that's the way it will. And you will probably watch if your hypothesis turns out to be true. Within that landscape, how is it that you're approaching investing? Because 1,000 ways to skin a cat. Multiple ways are right, multiple are wrong. What's your how are you approaching incremental investing? I mean, what was there was there. What is it that you're looking at incrementally?
So, the big change that we've made this year is move significantly towards domestic cyclicals. So, if you asked me this question middle of 2020, I would have replied that a significant part of our portfolio is aimed at exports, is aimed at leaders, is aimed at essentials, and we would not like to buy anything that has much of a leverage, because we were in an extreme risk averse environment as a marketplace, and we were worried that we don't fully understand how this COVID thing is going to play itself out, how much damage it's going to inflict. Today, I'm a lot more confident and hopeful that the domestic economy will come back. Maybe if not in the first quarter, second quarter, maybe as a couple of quarters roll forward. And to this extent, one of the big places we've shifted our focus is on financials. To my mind, the formation of stress over the October to December quarter, even though the banks cannot call them NPLs, they have indicated what these numbers are via pro forma figures. The NPL formation or the stress formation has been much lower than what we were thinking. And if indeed, nominal economic growth picks up the way it's showing it is, then I think the incremental stress will also be lower than what most people had feared maybe a few quarters ago. Valuations on financials are still well below, long-term median ranges. It is true that the ROE numbers are also not going to get back to the 20% or 22% you saw for several NBFCs or high teens that you saw for several banks. But then the cost of money is also not what it used to be back in the day. So net, my sense is that we wouldn't be out of place if we expect median valuation ranges on a price-to-book basis or a price-to-earnings basis to be achieved, which leaves a lot of upside. So that's one area. Then there is a back to normal trade, which is travel, leisure, entertainment, eating out, cinemas, etc., etc. You take your pick. Retailing. Some of these things are not cheap. Even though we are value investors, we are looking at them and trying to see if we can find some spots where we can make a reasonable risk reward case. So these are the kind of areas I'm looking at. What's done really well over the last 6 months or so are materials and metals. Unfortunately, there are so many global moving parts there that we find it hard to pinpoint exactly how earnings will flow. So we tend to kind of stay away from them. And there's been a huge amount of value unlocking in PSU stocks. They were incredibly cheap. I mean, several stocks were trading at high single-digit dividend yield in an environment where 10-year government bond yields were below 6%. So they were really, really good investments from that perspective. But after the re-rating that we've seen over the last 6 months or so, maybe bulk of the gains have been captured. Yet, having said this, if the government actually goes forward and allows these businesses to be actually run independent of influence or policy, prerogatives, then there could be a lot more upside than we can imagine. I mean, we'll have to see how that plays out. I mean, that's what the government has indicated. Will it walk the talk is the question.
Can I ask you, if you think, I mean, I'm not asking you to comment on a stock or the stock, but I'm just using that as an example that there is
Sure.
some forward movement on BPCL divestment. Say, argument's sake, I'm choosing that because of the Numaligarh news, etc. Are you saying that a re-rating in any of those stocks will happen materially only once the market gets the indication that even if the divestment is happening or is almost certain to happen, only once there is foolproof idea about the government having washed its hands off is when the re-rating happens, or a significant part of a re-rating from the current levels could happen if just pure pro forma the divestment moves forward. That's it.
It's a little bit of both. Okay, if you look at the journey of privatization, we haven't really seen anything significant take place after the first few privatizations took place. In the era of Prime Minister Vajpayee, right? So we are all sort of somewhat skeptical, if I may say so. Okay, there are bids out there. Unfortunately, BPCL bids were opened at a time when the market was going through a significant crisis globally because of COVID. So there are not that many bidders. We don't know, whether these bids will finally fructify into an offer that is acceptable to the government of India or not. So I think some of these things have to play out. So especially in the case of BPCL, I think if a transaction happens and if a business plan emerges that makes sense, I think the investors will be waiting to see that proof before they vote with their feet. Some people did, of course, position themselves for the privatization itself, and their journey has proved to be a little more trying, till now. But let me go back to what I said. I think privatization is only one part of the pudding. The second part of the pudding the government is trying to serve is that can it allow public sector companies to work with a commercial mindset? I mean, in the past, it's been very difficult because of, various investigative agencies leaning heavily on people who ended up taking the wrong decisions, maybe good faith decisions. Can the government actually deliver on its promise that honest decisions will not be punished? There will be no government interference. Commercial interests for PSUs will be allowed to prevail. If that happens and if that comes through, I think there is a huge amount of value unlocking in PSUs, which is still possible. We haven't seen much delivery on that. We've seen some talk on that. And to me, that is actually a much, much bigger driver, because then you're saying that, look, the government is a sponsor or an owner, but it doesn't run the business. But the business is run along commercial lines. And I think that to me is the real deal, if we can get there.
That will be interesting. Okay. One final question, Ashwini, before we thank you. I heard you mention in this interview that maybe 6 months ago or 8 months ago, you were in favor of the export-oriented themes, the tried and tested names, but you shifted. My question is, as an investor, how difficult would this shift have been? Because what you would have shifted out of, let's say, hypothetically, it's not that it was doing bad. I mean,
yeah,
they were doing okay. And the growth numbers still look good when you listen to the con calls of some of these companies as well, presumably. So how difficult is this, is developing this mindset, and how do you get about doing that?
So let me share what we do, right? One of the big tools that we use is historical price to earnings or price to book or EV to EBITDA, essentially various valuation bands, historical long-term bands. And it is our experience that whenever stocks break out of these bands, usually they are overvalued or undervalued, whether they break out on above or below. And one should use that opportunity. There will be some cases where there is a significant re-rating because the business has moved into another orbit, or management has completely changed its business strategy, and so on and so forth. So there will be those minority cases where these breakouts in the price earnings band or in a valuation band will lead you to sell, and you'll watch with regret as stock prices continue to soldier on. So that happens. But 8 out of 10 or 7 out of 10, these valuation bands hold. So long answer to your question, but the reality is that in many export-oriented sectors, if you watch these bands, stocks had become expensive. So while there is earnings growth, valuations don't have much room to go higher than where they are. So in the best case, you get earnings growth with no derating. And in the worst case, if the valuations fall to the median, okay, and you get the earnings growth, you don't make any money on the stock price. So it's not, so that's how it is, right? So we looked at some of those and we said, maybe it's time to take some money off the table here, maybe it's time to take some money off the table there, and that's how we went about it. We could still be wrong, who knows, but that's how at least we thought about it.
Well, Ashwini, thank you for sharing that, and this was lovely talking to you. I now wonder, why is it that we speak so less? So on the 2nd of March, I'm requesting you to come more often on the platform to give our viewers and readers the chance to experience your thoughts.
Thank you, Niraj. Thank you for having me this morning.
The pleasure was ours. And viewers, thanks for tuning into this leg of the Talking Point.